So you don't see it, stock nerds and market lovers. Zach counts us down to start the show. We're doing it remotely again because the campus to which we work may or may not be infected with the coronavirus. We're not 100% sure, but why take the chance if you don't have to? Zach counts us down. He stops counting at three, assuming, like, so rightly so, by the way, that I would just, figure out two and one and then start talking and we'd get the show going. No, no, no. Au contraire, the Connecticut School of Broadcasting bites me in the ass one more time where he's like, Tim, that's your cue to go. I'm like,
No,
oh.
no, no,
So,
no.
but we got
I said on one. I stopped at three. To be fair, you did what you did what you're supposed to do. You followed directions, and that's broadcasting.
but I've got a couple things though. Stockers, market lovers. Danny wants to do. Danny has a little. Danny's as I adjust my camera. Danny's philosophical corner. I don't have a segment to call what Danny wants to talk about, so we'll just call it Danny's philosophical corner. I want Don to do what's known as sequence of returns because I think that's important, especially in a 2022 market. Then of course we'll get to the normal stuff with Alex and Hunter. But real quick, uh, when a business changes and adapts, I think it's important to note those changes and those adaptations. And I want to show you Kroger here. Kroger's super interesting to me. You can see Kroger on a daily is having this 6% move up today. Just this big move. And it's like, well, probably a number of reasons powering it through here. And you can see it comes from, let me show you this, this base that it took out the last 2 weeks, this little tiny flat base right there. And what's interesting about Kroger is it's adapting. And a lot of people might wonder, well, how can Kroger, markets, supermarkets, food in general has super thin margins. There's inflation. Everyone's getting squeezed, quote unquote. And yet here we are, Kroger, 52-week highs. And by the way, I don't know what the old, we'll just look together here. What is the old lifetime high of Kroger? This can't be, oh my gosh, is this it? This is a lifetime high of Kroger. I didn't even realize that. So you're looking at a lifetime high of Kroger, and what's this business model change? Kroger is interestingly enough. Now I get supermarket news. I highly encourage everyone to read supermarket news. They're going to become a ghost kitchen, and that's super interesting to me because now where you have you're taking this huge concept of ghost kitchens, where like Guy Fieri from Diners, Drive-ins, and Dives, where even places like Chuck E. Cheese has a ghost kitchen that makes wings. And you would never know it's Chuck E. Cheese's wings, right? Because they call it something else like Mouse Hut wings or something. But now you're taking the restaurant concepts, you're putting it where the food is, and you're eliminating one entity, and that's a food distribution network, like a food, like there's United Foods and a couple other big ones across the country. And so now Kroger is not only becoming a retail food store, but becoming a wholesale a food purveyor. They're selling that food in the ghost kitchen to the people making the food, and then of course you call and order chicken wings from Chuck E. Cheese. Don't know it's Chuck E. Cheese chicken wings, and you get them delivered by DoorDash, and you think you're all cool and hip, and here's just Chuck E. Cheese chicken wings. That is a huge business model change, especially, and that goes across the board. That's Kroger is not just Kroger. It's Ralph's out in Southern California. It's King Supers up in the Pacific Northwest. There's this is really huge because now you don't have to rent different space if you're a ghost kitchen. So Kroger not only is a landlord, they're a food distributor. It's a huge business model change, and you can see it showing up here in the chart at Kroger's. That means Kroger's going out and it's a screaming buy, buy, buy. No, it has nothing to do with that. It has everything to do with recognizing when business models change. Is there somebody that can else hear the train whistle that's in my ear? Does anybody
Yeah, I
else
can hear.
hear like
Yeah, I
I
hear
do
that
hear
as well.
okay,
something faintly.
okay, so can we address that for a second? I don't know if stock nerds and market lovers can hear that, but it is really hard to do there it is again, a sermon on Kroger from Sermon on the Mount. While there is literally a train whistle going, like, and it's not a train whistle like you would hear in a current locomotive. It's a wooden train whistle you'd see Sheldon Cooper blowing into on Big Bang Theory. Zach, what do we
On
think
and
of
off.
like what
Well, maybe noise
Don,
reduction. I can knock it down for the audio listeners. Maybe.
Is it in and
Zach?
out?
I don't know.
Whistle.
Yeah, it's in
Yeah.
and out, man. Is that you, dude?
My dog barking in the next. Believe it or not.
I can't believe that your dog would sound like a train whistle.
I don't think that's a dog.
Could be
It could
Okay,
have
well
been in the
well, that's what you know. What? Hey, we should do the show from home. We shouldn't take a coronavirus. You know, we take the risk of coronavirus. You get a train whistle every now and then. That's okay. So anyway, Kroger. Those are the risks, folks, with live television and broadcasting. Kroger, super interesting. I would watch the whole space here, and I'm quite sure Alex or Hunter can bring me some different stocks that I failed to gather that might be benefiting with turning their large spaces into commercial kitchens is what they're really doing, and then becoming the food distributor.
Yeah, I
But
can think of one right
inflation.
now.
Go ahead. Go ahead,
Sprouts
man.
Farmers Market, SFM.
Oh, give me the. I wonder
They're
what
out
are
of
they doing
they're out
today?
of Arizona.
Yeah.
They're a local.
Yep.
Um,
hmm
I was there the other day
I've got
food
one.
shopping, and a lot of people were sitting down eating and stuff. So
Well, yeah, like what Kroger's doing isn't just going to be germane to Kroger. Any place that houses all that food that can then sell it to branded name, like Logan Paul has a burger chain. Like for those of you that know influencer space on YouTube, like
Mr. Beast, the influencer, has one as well. Runs
yeah,
out of Brio Italian Kitchen. If you're in DFW,
Mhm.
they serve burgers out the back. I'm not kidding. It's weird.
yeah,
Huh.
and so this whole move right here is super interesting to me, and I think the retail space, the retail supermarket space is when they say prime for disruption, the disruption's happening right now. But speaking of prices being thin and margins being thin, and with inflation, I've seen a bunch of research pieces saying the selling the bullish side of a market, meaning the stock market. And as we look at S&Ps here, we're taping the show early Thursday afternoon of this week. S&P's down almost 1% on the day, selling the bullish nature of stocks. And I think it really helps to come to the markets in 2022 with a neutral bias. And it's hard to do so. Like I can see people getting, uh, you know, the market's been bullish for so long, and it's easy to come to the market with a bullish bias, where the S and P's find support continuously here at the 21, and then they march higher. And nothing's changed, by the way. Like there's no reason to be super duper bearish here at the moment. But then I see the other side where people are really bearish because of all this inflation. Um, and I think it's interesting about having the discussion and thought process about inflation that here we are with inflation that hasn't been as high as 1982. But what a lot of people don't realize, just a couple things that you might not be thinking about, that inflation had actually peaked in about 1980, 1981. It was actually on the downside come 82, even though we're starting to come out of the recession in 82. That's interesting to me. But what is different now, and you'll hear the bullish camp say this, is that, well, we have inflation, but we have great employment. And I don't know if we do have great employment. We have great employment numbers, but numbers can be anything that you want them to. Some people look at some numbers and they say they're great. Some people look at them and say they're bad. Participation isn't that great in terms of employment. Have we created any brand new jobs since the pandemic started, or have we just been trying to gain back ones that we lost because we literally shut the job engine down in March of 2020? That's something to consider. By the way, the answer is we haven't created a brand new job per se. And then there's a camp out there that will tell you that the market had gone up uh, really considerably. The market went up considerably from first rate raises back last decade through this period, till the pandemic, and they were raising rates up until a point. Market went up considerably from '04 through '07. And the thing that those two markets in particular didn't have was this kind of inflation. And if you compare that inflation and you say, well, it's not as bad as 1982, I don't think it's fair. It's not a fair comparison to compare this market and the market that we're in to those early 80s markets and what Paul Volcker did by raising rates upwards nearly of 20, 21%. Look, this market getting, Danny and I and Don, we've all talked about it, this market getting getting just a couple, three or four rate raises is equivalent. I think you need to think in terms of equivalency. So the rate raises that were taking place weren't taking place with this almost stifling inflation. And you're like, you're going to cite some spending numbers, which, by the way, look in arrears. But I want to show you crude oil here on a weekly chart. As a matter of fact, let's look at crude oil on a monthly chart. And you can see it's had this nice move. It's kind of consolidating at recent highs. Crude oil is crushing people, and it's energy. Energy is crushing the Northeast right now. And you're like, well, Tim, it's winter. Of course, it's cold in the Northeast. No, it's colder than normal. And people soon enough, this is my thought, are going to be making decisions on spending based on how much they have left over by trying to heat their homes. It's a cold winter right now. Cold. It's not unseasonably warm like you would hope with energy prices being so high. Hunter, can you give me a stat on how high energy prices are here? Let's just do it. I'll do it from the low. Look at crude oil here, just from on a monthly chart. You're up over 1,000%. Okay, well, like, Tim, that's not relevant. Well, I think it is a little bit relevant. Let's talk about that. Crude oil goes down in 20 to a low was 6.5, and now you're up over 1,000%. So you want to get to work, and you have that big truck, right? Because that's what they make. We make trucks in this country now. We don't really produce cars, okay? And so your energy costs have gone up since the lows of 20, over 1,000%. Heating oil, natural gas, all of these commodities are up, and so I think it's extremely disingenuous to say that the markets can continue to scream higher and compare their last several rate hiking sessions by the Fed when you don't take into account that what this particular level of inflation is doing. And it goes beyond just the normal food and medicine. It goes right now. It's getting to those jobs. It's an economy that doesn't go to the store quite as much. They want everything delivered. And what we have on our screens right here, this energy chart, is extremely, I think, bad for markets. I think it's very likely that if the Fed on a program does 3 rate raises, right? And they're not going to tell you. I mean, that'd be foolish of JPL. Go, we're going to do 3 rate raises and then be done. Well, why? How do you know 3 is going to kill inflation? You're going to want to take it rate raise by rate raise. This number right here, it's on my screen, is going to absolutely affect future spending numbers. And eventually it all catches up. And I think that's a really good pausing point. I want to get Danny's thoughts on that real quick, because we always go to Danny's economic corner and then we'll jump to Danny's philosophy corner. But I think right now the Fed's in a really tough position, and I think what you're seeing here, as represented by high valuation stocks in the NASDAQ, they're struggling right now to get above their 21 exponential moving average. And it'll be interesting to see how these stocks fare in the coming weeks. They'll probably catch a bit of a break as they move into tech earnings towards the end of January. But I think that markets they're going to have some flushes here in probably the near future. Danny, what do you think?
Well, a couple of things that I like to bring up. Number one, you mentioned the participation rate. They're trying to say that everything's hunky-dory and the jobs are good, but they reduced the participation rate by 4 or 5%. It shrank considerably. So if you use the same participation rate, and participation rate means how many people are in the job or in the workforce or looking for jobs. Well, if you get discouraged and you stop looking for a while, they stop counting you. But if someone gave you a job, you'd take it. So shouldn't you count them? But if you just use the same participation rate we had just 2 years ago, the unemployment rate is high single digit. It's not anywhere near is 4 level or whatever they're proposing, in my opinion. With regard to inflation, you mentioned that it's the highest inflation we've had since 1982. Folks, let's remember, from 78, 79 to 82 was the highest numbers of inflation we've ever had in the modern era since they started taking inflation data, when they started measuring inflation. That's when the misery index came out, all that other kind of stuff. So this inflation will squeeze profits. It will hurt if if you don't pay attention. And here's the thing: I'm not bearish right now. Like you said, the market's okay. It's kind of right around support, and hopefully it holds. But if you go back and look at the late 70s, early 80, 81, if you had a 60-40 portfolio or just a S&P fund, you got hammered. You got crushed. So, it's possible. I'm not saying it'll happen, but it's possible that you may give back all the gains you made in the last couple of years, last 2 or 3 years in a bad market if inflation continues to rise. Now, talking about the Fed, you're talking about interest rates. You're right, Tim. Volcker went in there and he raised rates a whole bunch of times, but rates were higher. So as a percentage of that quarter point raise,
Yeah.
it wasn't that big of when you're coming off such a low bottom where you're at historically low or almost historically low interest rates. A quarter point is a much bigger percentage. It's a bigger magnitude. So just 2 or 3%, and you kill him. Look, I would not want to be Jay Powell right now because he's got this dual mandate of full unemployment, and keeping protecting the dollar via keeping inflation in check. And those are actually opposite sides. I mean, those are two diametrically opposed outcomes, because if you protect the dollar and raise interest rates to hurt inflation, you're gonna kill jobs. So if he
Right.
doesn't kill inflation, if he lets inflation run, he may be able to keep some jobs. So he's got a tough. I mean, he's got a tightrope here. But the other thing is, I think that just buying and holding right now is much more dangerous than it was just a couple of years ago. The market's, cycling. There's different times where certain strategies work, and there's certain times that they don't work. And if history repeats itself, and there's certain sectors that do well during inflationary times, and there's a lot of stuff that doesn't. I mean, just take a look at bonds. So it's going to be interesting either way.
Now, that's a great segue into a question that came over the email recently, and it was about how to handle this type of market, or how we're handling this type of market, and how to handle this type of market. I think that's a really good opening for a philosophical discussion, I think, that you want to have, Danny, with viewers.
No, absolutely. So I actually got an email. I got an email from a client, and he was making the comment of just, recently this beginning of this year, starting out, and he's noticing, and he's kind of semi-retired, so he's able to pay attention. And he said, we continue to outperform on the downside and underperform on the upside. And so he's kind of questioning that. And my response was, whenever we're being defensive, have more cash and or hedges, we will outperform on down days and underperform on up days. That's the nature of the beast and the strategy. Once the dust settles and we get a defined trend, like an uptrend, and get more fully invested, we can outperform or match in the same direction. We'll be more correlated. Right now, we are not correlated as much with this market by design. Okay, so I said, look, in the first 5 days, we outperformed. The couple days you got this oversold bounce, we underperformed. But I don't want to get too myopic and short-sighted about daily moves. I'm in it for the long haul. Here's the question you have to ask yourself. And you were talking about philosophical questions, and this kind of ties in with what the Fed's doing, Tim. The question you have to ask yourself at this very moment is, do you think risk is higher or lower at the very moment? If you think risk is lower, we can certainly dial it up a few notches for you, but I personally don't want to go all in at this moment. We don't have any growth stocks currently. And this was a couple days ago. This was on the 11th. I said, today, growth stocks actually did the best after selling off 5 days in a row. That was because of an oversold bounce. The indices are broken below support, which means higher risk. Anyway, point being is, and by the way, in full disclosure, since that, we've added one position. So now we're about 2/3 correlated to the market. Before, we were a little less than 50%. So, you dial up and down risk with cash management, with how much cash you hold. Cash is an asset class. Or if you've got a few positions you don't want to unload, you don't want to sell, you can throw on some hedges. That will also smooth out the volatility of the portfolio. But I tell you what, if you look at historical and, folks, we're an active manager. We don't, seasonality and all that stuff, we take it with a grain of salt. But the January effect is fairly, if you're going to look at some seasonal data, the January effect is probably one of the most reliable, meaning you have a lot of tax loss selling, tax loss harvesting toward the end of the year. And then people start buying early January, right in the first 2 weeks or week in January. And it's called the January effect. And normally you have a January rally in the first couple of weeks. We're not getting that. There's also an old adage on Wall Street, so goes January, so goes the year. Now, that's kind of just a rule of thumb, kind of a crude heuristic, but there's a little bit of truth in that. So whole point is you may need to buckle up. If you're going to have a pie chart, you better be willing to have a pretty large drawdown. And at the very least, you need to add some other asset classes than just bonds and conventional stocks. You need to add some, commodity exposure, energy companies, commodity type companies, some precious real estate, whatever. You need to have a different pie chart than just a year ago. So
absolutely. That's a good spot to bring Don into the discussion now, because I don't want to put words into Dan's mouth here, or Danny's mouth. What a lot of people will try to do is force the issue, because oftentimes individual investors could be prone to over trading, especially in a market like this, or wanting to inflict their will onto the markets. They think the market should be doing X, whether it's long or short, and this is where I think things get really dangerous. But there's this natural occurrence with markets called a sequence of returns that I think Don does a really good job of helping investors, one, understand the concept, but two, I think it's calming to understand how you make your returns and how you can make headway, because for a lot of folks, I don't know if the first couple of weeks have felt settling to them and how their confidence go as we come down a little bit more here as we hit the last hour of trade on a Thursday. Don, can you clue us in a little bit more, make us a little bit smarter?
Returns is the concept of returns over the long term, 9% annually, but it doesn't give you a year. It varies dramatically with economically ship in the markets, with who's in charge politically, who are things good for business or bad for business. The actual points that you get are all over the chart.
Tell you what, Don, we're having a little trouble hearing you.
Just
and you're
a little
cutting
bit,
in and
yeah.
out. Yeah, that's all right. I'll tell you what. Let's do this. We can come back to sequence of returns here in a moment. Maybe Don wants to re-log in. Hunter.
Yes, sir.
Look at this. Look at Hunter. Hunter's not even frantic. He's like, dude, I'm ready. Put me in.
His internet works now.
His internet works
now.
That's right. I'm all good to go.
Hunter, I was thinking about you last night. I was screening,
wow.
and I
He was thinking about you last night.
I know. I didn't know where we were going with that, but
I'll leave that one alone.
I'm stalling now. Hunter, as I was screening last night, you came into my head. Let me type in here, log back in. So I'm almost certain, and Nutrien, you've discussed Nutrien in the past, right? I swear this is a stock. This one popped up down a little bit today. This one popped up on my screens I talked about in the video last night. But then I'm almost certain too, LPX. I don't know if you talked about Boise recently, but LPX and
I haven't
Boise
talked about
like
Boise because it doesn't have the Boise. The only reason I typically
volume.
mention LPX is the liquidity is a lot better. Yeah, Boise's a little bit less liquid.
Yeah, and so, but it's interesting, the commodity space. And let's look real quick. I'm curious about BLDR here.
Right around the 21 and the 50 area. Yeah.
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 Yeah, that LPX, boy, I was like, gosh, I'm almost certain that at some point in 21, you were discussing all four of those stuff. Maybe not Boise, but that space most certainly. But anyway, what do you have this week? And then we'll come back to Don. If someone can just give me a heads up when Don's ready, we'll get him after. We'll try to get him in
Yeah.
after.
Can you hear me?
Go ahead, man.
Yes, we
Yeah,
can hear
we
you,
can,
Don.
Don.
All
It
right.
sounds very clear now. You
Yeah,
want me to
it's
go
really
ahead and
good now.
roll
I'll
with
tell you
it,
what.
Tim?
I'll tell you
Or you
what.
want to go back to Don?
Don. Let's go back to Don. We didn't get into it too much. I think we did a good job of stalling there. Don.
I think the issue was as soon as I started talking, we broke the 50-day moving average on the S&P 500. So that's probably what threw everything off.
Yeah,
Very,
probably.
very key
So,
level here, 4680,
yep.
4681 on the S&P. We just dipped below it. Now we're right back at it. Anyway, sequence of returns is the market returns 8 to 9% annually, but not every year, depending on what's going on politically, economically, and what the Fed is doing. Probably most importantly, so your returns can be all over the board. And the long-term uptrend is made up of a bunch of intermediate and short-term that can be very detrimental to your portfolio if you don't get out of the way during these harsh pullbacks. Just look at what happened with COVID, 34% in 5 weeks. The financial crisis, 57% over 2 years. Bursting of the tech bubble, 53% over 2 years. So you get hit with that going into retirement, and you think you might have been set up fine, but if you don't take action to protect your nest egg, you're set up for not the enjoyable retirement that you might have thought you were in shape for. So, and that's really the big difference between Revere and typical asset managers is that we do protect that downside. Right now, our risk is about at 60% of what the market is overall. If we decisively break through this 50-day moving average again, we're going to dial that risk down even further. So, but the market has been extremely choppy. There's virtually no growth stocks that haven't survived this carnage. There's a couple. It's like finding needles in a haystack. Everybody like Tesla yesterday was up 4%. Today it's down 5%. Marvell was one of the darlings of semiconductors. It's down 6% today. It's just not a good market for growth stocks, and that's going to trickle over to the overall indexes. There are places to hide. Staples will outperform, utilities will outperform, but all that rotation takes place within the S&P 500, and that's kind of the situation that we're in now. Is our only broad exposure is the S&P 500, and as money moves out of tech and into staples, into utilities, into oil, into basic materials, we're losing on one side, but we're gaining on the other side, and we just wait for a fat pitch to come down the middle. And we certainly don't have that right now with the market. Dan's very fond of saying that the risk is in the market. It's not with the individual investor. Everybody has a very high risk tolerance when the market's going higher. But like Mike Tyson said, everybody's got a plan until they get punched in the face. And your risk tolerance is drastically lower when the market drops 34% in 5 weeks than it was when it's screaming higher.
Okay, and as we're talking, Hunter, now I'll come to you here. Let me show you the ticks since I can do this in real time with folks. So, right after noon, you had this clearing, really huge downside tick. This is the selling right off of the New York Stock Exchange. The tick picture is just steadily trended lower here, and you're seeing this is an orderly sell-off right now. Really hard to get excited about anything. And it's interesting too, because as Don mentioned, you broke the 50. I don't know if that holds, if it buoys back here in the last 50 minutes of trade on a Thursday, but you're going into a 3-day weekend as markets are closed on Monday. So curious what taste is left in investors' mouths after this week. Super interesting. And then you get the start of bank earnings, I believe, tomorrow as well. Hunter, what are you looking at, man?
Yeah, man. So like we've already talked about, or like Don said, there's not a ton of growth stocks out there that have been able to withstand having a major pullback or getting cut in half whatever you want to call it, over the last year or so. And a lot of the ones that did survive have gotten hit really hard over the course of the last 3 or 4 months. So with that being said, most of these stocks I'm going to cover right now are what you would say are very cheap from a valuation standpoint. They don't have very stretched PEs, but that seems to be what the market has been supporting a lot more so than the high valuation, high beta names. We've talked about that a pretty good bit over the last week or two in the nightly videos and whatnot. So first things first, Tim, will you pull up John Deere for me?
Mm-hmm.
And so you can see Deere had a really sharp move. We talked about this last week too. Sharp move over those key moving averages. We're now seeing the 21 cross through the 200, all that stuff. Those moving averages hook back up. But what's important here is DE has handled this move up in a very orderly fashion, while the market and growth stocks and lots of other things have been very volatile, very up and down, breaking key moving averages. John Deere and then Caterpillar as well, Tim, if you want to pull that one up. They look very similar in regards to the last week or week and a half of trading. Also, really nice way of handling the strong move up, not giving a ton back. So these are two names that are showing some relative strength over the last week and a half in a big way. Not a ton of volatility while we're seeing a lot of volatility elsewhere. I just wanted to highlight that. And then, Tim, if you want to, just to kind of show the sector, XLI, the industrial sector, this continues to be a pretty good performer as well. You can see it staying above the 21, back above the 50 and all that good stuff too after a brief dip below. But for all intents and purposes, XLI continues to look good and look like one of the better sector ETFs out there. Next, Tim, will you go to OIH? This is the oil and gas services ETF. I talked about this on both of the videos, Monday and Tuesday. Had some really big outperformance last week and continued that into this week. The names that you're probably most familiar with in here are Halliburton and, Dan, I'm going to say this correctly, Schlumberger, SLB. So HAL and SLB are the top two names in here. They really carry this ETF, but showing some big time relative strength as oil has moved higher. Last couple here, Tim. Micron, I want to highlight this one here because it is on the cusp of making a potentially very big move. However, it looks like today it's getting rejected from making that move. And it's very close to a breakout, as you can see here. Highs on the left side of the screen going back to March, April of this year, around 95 to 97 range. So today we actually got above that, not holding above it now. But if you look on a monthly, roughly this 95 to 98 area is also the highs for Micron going all the way back to .com bubble. So this is not only a big breakout on the daily, but possibly a very big breakout on the monthly if it can actually follow through. So not seeing it follow through yet, but I do want to keep that on your radar. It's one of the better looking and better acting semiconductor stocks that has not broke down. And wouldn't you know it, it's one of the air quotes cheapest out there. Last two here real quick.
What an interesting
Nucor.
One second. No, it takes 1 second.
Go ahead.
What an interesting thought on buy and hold. Like, and I say that because someone looking at the screen, surely nobody held this the whole time. No, somebody held this the whole time. And to think about everything that's transpired in the stock market from 2000 to 2022, and someone has owned Micron that entire time, and now they're just getting back to even. Oh, that's assuming that they bought it up here. But they really haven't made much progress, right? Like, it's just, I understand buying, like when we do, and we've done it with IPOs, like if you just bought $10,000 worth of Apple and you held it the entire time, you would be a gazillionaire. But this is really the reality. So you can hold it. Like you just need to understand what you're getting into. Like this has been, it all depends on where you get into it. That's why I think you need triggers. We talk about triggers on this show so often. Like, what's your trigger to get into a stock? What's your trigger to get out? And it has to be something on a chart, like fact-based. And if you're going to take a flyer on something, understand that you're doing just that. You're taking a flyer on something. Whoa, what an interesting study in human behavior this chart is. Go ahead, man.
Yeah, man. My last two here, two, I guess, commodity-related names. Nucor, NUE, being the first one, had a pretty rough shakeout on the 11th, but came back, finished at the top of the range. This is a stock that is very prone to volatile moves one way or the other. Would not be surprising for Nucor to be up or down 5 or 10% on any given day. So keep that in mind. But it has come back up to the 50 and the 21, kind of sitting there right on it. One to keep an eye on here as it's reclaimed those moving averages. Steel wasn't looking so good early in the week, but they've recovered nicely. Most of those have. And then FCX is my last one here, Tim. Freeport, which is made a pretty big move, as copper has also made a big move. We talked about copper, I believe copper and FCX on last show. And so FCX moving out of a consolidation range, gapping up, and holding up relatively well today too. I mean, it's down 1%, but the market is down today. So that wraps it up, man. That's all I got. Actually, I do got one last thing, Tim.
Absolutely.
Actually, I want to lead.
Go ahead.
I want to lead into conversation with you. Will you pull up the dollar? I would love to hear your commentary or opinion on what's happened to the dollar over the course of the last 2 or 3 days as it's kind of broke down a little bit.
Yeah, the dollar breaking down in the markets. It's interesting. It ties into TNX. TNX is down today as well, and the markets are struggling here. It started struggling, I believe, when Brainerd started testifying this morning. She's going to be. She was nominated to be the vice chair of the Fed, and she's really hammering home, beating down inflation. The way the markets have acted the last 3 days, they haven't fallen apart as TNX has come off and the dollar coming off was a positive for bulls. And now you have these two positives, the rates coming down and the dollar coming off, and markets are really struggling here. And I think what this is saying is no growth. Like the dollar going higher would signify growthiness, and now I think it's saying that you have and this is on a day by day basis here, but where's the growth going to come from? We've talked about this in the past, where you've pumped in trillions of dollars into the market with stimulus, and all you have is 2.3% GDP to show for it. Going back to labor participation, with a lower labor participation rate at quote unquote full employment or close to full employment, where does this growth come from in this country? People at jobs generate GDP. And right now, where's that coming from? When you're looking out into the next few quarters of 2022, if inflation is going to take away buying power because of higher energy prices from consumers, where is there going to be all the demand that we've seen up and through the holiday season? If people are going to drive less, are there going to be the robust car and truck sales, like we make trucks in this country? So what are truck sales going to do, or SUV sales going to do, even with a limited supply in the market, as energy prices don't seem to want to stop if they cross 90? Like at this chart of crude. And this all ties in together to a dollar question. If this chart of crude here, you're at crude oil, if you break through, you're at 81. But it's not that inconceivable to think that you're not going to take out this high here around 85. You break through 85 and you reach up to 90. That's a big deal, especially if it happens this winter, in the height of people trying to not just combat inflation with feeding their families, but trying to heat their homes, trying to get to jobs. Like, this is a really big deal. And so, yeah, I think the dollar is telling you that it's lower growth prospects right now. And great
Tim,
for
the takeaway is inflation is sucking all the growth out. I mean, bottom line.
Yeah, there you
Just
go.
keep it simple.
Yeah, and so it's not all. I don't think it's all bad. Meaning that you've had a reset down to the weekly 21 with the dollar. So maybe that's what you needed. Was it could be simple as it's a crowded trade? Like, they don't tell you this. Like, hey, is it a crowded trade and everybody was long the dollar? Now they're getting beat to smithereens, and now it's had this shakeout. It's finding support at the weekly mean. I don't know. I kind of think that inflation and the dollar right now are trying to tell you something, and growth prospects are going to be tough. And the Nasdaq then you tie that into the NASDAQ. And that's why you'll hear me say constantly, it's never one piece of information in a vacuum. It's modicums of other pieces of information put together to form your sight picture, to give you situational awareness. And the high valuation growth stocks, they're going to struggle in this environment, and that's what it's a reset that you're seeing, and it's not all going to be done at once. And so eventually this trade will get too crowded, the reset trade for high valuation stocks, and they'll zoom up and suck some people in. And you got. I mean, this descending 21, definitely interesting. So I think dollar, what Danny said, yeah, dollar growth is being sucked out, and that's represented there in the dollar. So hopefully that helps. Alex, what you got, man?
Yeah, so I've been looking at, and I entered a few days ago on my tracking portfolio, GLD. If you could pull up like a 20-year weekly on that, that would be great. So I know I was kind of looking back, and I noticed that when QE happened, gold kind of went into like a bear and didn't do much the whole time there was quantitative easing and massive money printing. And now that we're kind of pulling back, I'm wondering if this starts to trend higher again. And if you look at a 3-year weekly, a little bit tighter, so a little bit more from this past year, that if you use that 21-week moving average, I'm like Tim in this sense that I like to use that average more than any of them on the weekly. That's where I entered. So it was like around that 168 area. I have a defined stop. I usually use like 3 to 5%, depending on the day and the volume. And if it's coming down hard, I may get out earlier on that 21 week, may keep it really tight. But for now, it's going up, or at least it's holding up in a really tough market. So that might be a place to avoid your opportunity costs and holding a big cash position, because if there's inflation and the goods are going up in price and the dollar's going down, you're losing money on your cash position. If you were to plot it on a graph, it's going to be going down. So I'm trying to avoid that. So maybe gold's a play. Couple individual stocks I do see strength in, and that's probably because they're tied to real estate. If you could pull up Lowe's, LOW. It's pretty amazing that this name has held up near its 52-week highs for a good amount of time. And then when we had that nasty shakeout earlier in the week, it put in a hammer. I talked about that on the last podcast, where the stock opens up, it breaks down, and then closes right where it opened. You could see that big wick underneath that bar on the 50-day on that red bar right there 4 days ago. Nope, right there. That was a good sign of strength, and it kept following through, and it's kind of like hanging in there. So I do like the look of it. I would like to see it just depending on the market, because you could find like a perfect setup, and if the market's going to come down, unfortunately, if the tide is going lower, you could buy a cruise ship, it's going to go down with it. So it doesn't really doesn't matter how perfect the setup is and how great the fundamentals are. But I do like this name. I think that gold, and then my last one, actually, Hunter has been talking about this name, and I looked at it more today, and NUE. I mean, Hunter, you could take over on this. Did you talk about that just now? May have missed it if you were talking about that.
Yeah.
Hunter, are you there?
I don't know if we lost Hunter, but I think we lost.
We probably lost Hunter.
Oh, no, I'm here.
I'm
here. My dog was screaming, so I put myself on mute to avoid any more train whistles.
Sorry to put you on the spot. I was saying, did you just review NUE? I might have missed it when I was looking at some charts.
I did. I covered it briefly.
Okay.
Just that it was.
Yeah, I agree with Hunter on this one. I'm on his team on this one. I think that these type of names, non-growth tech names, could work. It's holding its 50-day. Maybe this is a good risk to reward area, RR. You just gotta. I would just tread lightly, but if you have to buy something, there are some names, but it's okay to be in cash. But is it okay to be in cash for a long time? And that's where I get into the, what do you do? Because at some point your cash position in a high inflation type economy, that that's going to hurt. I mean, what about people that don't own homes or don't own hard assets, and they're just collecting an income? What do you do with your money? So I think finding names or positions like maybe potentially a gold position or an S&P 500 position like we have in house off a big moving average, like the 50-day or even the 200-day, that could down the road, longer term, like Dan said, can yield some good results. We're not short minded here. We're not looking one next week. I don't want to get a quick trade. That's not what we do here. So it's having that process, and we try to stick to that process.
All right, Don, you want to
Well,
cover?
real
Go ahead.
quick,
I'm sorry.
just I want to clarify one thing that Alex said, so that I know the traders and the active investors know what he meant, but for the people that just joining or new to the program, when he said tread lightly, you can take some positions, tread lightly. He's talking about take a smaller position size. Start building the position. Don't just take your normal position size when the market's choppy like this. I just want to clarify that.
Yeah, thank
Sure.
you, Dan. That's true.
Don, I know Thursday's Hunters video, you'll have the 21 over 21 and take us into the weekend. What are you seeing shaping up?
I'm going to have a hard time finding 21 over the 21 if this market keeps up. But that's okay, because that tells us everything that we need to know about the state of growth leadership in the market. It speaks volumes in its lack of leadership. And that's why we're, sitting on our hands waiting for the fat pitch. Don't know. You're always ever 4 days away from a follow-through day in the markets. Today was day 4 off the bottom, but we're going in the wrong direction today. I do want to point out.
And Don, what would violate that violate that follow-through day for our viewers?
A break of the lows of 4 days ago.
Of day one, okay.
In the indexes, yeah.
Yep.
So that was the 10th where we bottomed and had to put in a big hammer candle close at the highs of the day after a rough shakeout intraday. And right now, then we had 2 days up. We paused at the top of the range, and we broke back below the 21, and now we're testing the 50-day moving average on the S&P. NASDAQ looks much worse. Dow looks better. Mid caps and small caps, well, they've been small caps especially have been underperforming for a while. Mid caps not quite as bad. Changing the subject, but I do want to congratulate Guns and Sweetums on their excellent Week 18 performance, which allowed them to avoid finishing last in our fantasy football league. Tim, I seem to remember you taking the Young Guns over Domination.
I think he did.
Of the year.
Yeah,
I think he
did
did.
they beat you?
They are basically the Carson Wentz of who lost to the Jaguars the last game of the year to give.
Oh, you went to that game?
The playoff spot that was there for the grab for the Indianapolis Colts, but dominated by the 3-win Jaguars there, and I finished third on the year, and Guns and Sweetums finished after taking a lot of abuse from me in our intra-league comments, managed to rally from 10th to 8th the last week. So on to next year.
Improvement.
There you go.
So now does that mean next year they start getting some of the first draft picks?
No, we start from scratch every year.
Yep.
Everybody starts from scratch.
All right, I'll tell you what, Danny. Let's do this. Danny, I've got one last thing, but will you give us the short outro, the one where it doesn't take you forever to get through it, please?
Wow. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. RevereAsset.com. Just send them there. They can sign up. They can sign up for it, subscribe. They hit the subscribe button, sign up for our daily market newsletter, and we won't spam them or email them, hassle them in any way. It's up to them to reach out to us if they want a complimentary portfolio review or just have questions or a topic they'd like to hear on the show. You can email any of us, Dan at revereasset.com, Tim, Hunter, Alex, or Don at revereasset.com. And you can always call us old school at 855 Real Wealth.
That was smooth, Danny. That was really good. I'm going to give you high praise. Yeah, man. High praise. So real quick, someone asked me this over Twitter. Earnings season is coming up and expected move. And there's two things to point out when you look at this is on Thinkorswim. Not every platform has both of the things I'm about to show you. Every platform has implied volatility by percentage. And so you can get an implied volatility number on an options chain. And you can tell when earnings are. If you don't know when earnings are for a stock, like they're not on your chart, you can always look for the highest implied volatility in the chain, and you'll find where earnings are. I can tell you that next week, within 8 days, Netflix is going to report earnings, and I can tell that because the implied volatility is higher. So what the market makers do is they increase the price of both calls and puts. It's an unknown event, and so what they do is they increase the volatility and the expected move that would normally be there for this week. And you can see like a normal week down here, you're in the 30s for implied volatility. And so up here, you're at 64%. This number is going to increase as you get closer to the unknown event. And then what that makes traders do is pay up for calls and puts. And so it's a way that the house continues to always be the winner typically in an earnings period. But the number that's associated next to it is the plus with the plus or minus. That's actually today is Thursday. What is today's date? 13th. And so it's about a $42 move, plus or minus, up or down on a $522 stock. And so that's what's being factored in, and that'll adjust and change. But there's a number of strategies you can employ off of there. But I had someone ask me what the numbers meant, and looking at expected move and what the market maker said, and that really is where I look to see what's expected for earnings. If you go it's a certain multiplication factor above this number, you'll get what's known as a runner, and that thing will start running. Same thing to the downside. If you violate this number to the downside, you're going to start wanting to find support levels and look out below, because the market makers are taken off guard and they're going to be scrambling to cover their bets. So hopefully that all makes sense. Any questions, just email me, Tim at revereasset.com. Danny, take it away.
Folks, we'll talk to you next week on Your Money.